So we'll go through this. If you haven't attended this, this is I probably a 20 to 30 minute brief. I haven't timed it, and then we'll open it up to Q&A. So if you guys have questions or whatever, you just want to talk about a particular topic, doesn't even have to be specific to this, just anything to do with real estate, then yeah, we can dive into that. So hey, Julie from Roseville, thank you for coming. Very much appreciate it. So, all right. Well, hopefully my stream is working on Facebook. It says it's fetching. Just let that marinate for a little bit. All right, I'm gonna go ahead and share my screen with you guys now, and then we'll get this ball rolling. Cool. I'm gonna leave the chat box up on my other screen, so if you guys have questions throughout, hey, welcome from Chico, Alicia, awesome. Feel free to throw them in there. All right, I won't keep you guys waiting. Let's go ahead and get into it. So if you haven't attended this before, this I call the State of the Union. So this is a monthly update on the U.S. economy. Specifically right now, we're focusing on the progress made in the recovery in light of the coronavirus pandemic and the great shutdown, and then a market update. So I'll update on the housing market, and then mostly commercial multifamily, since that's really my focus, but often I'll dip into, other things like maybe self-storage or whatever tickles my fancy for that month, or if I have a request from someone to look into something. So if you guys want to make a request for next month, feel free to do that. So hey, Chris, thanks for coming. All right, let's dive into it. So, a bit of background about myself, if you haven't heard me speak before. I'm originally from the Boston area. I moved to California a couple years back. I started my career in military aviation. So I flew the B-1 bomber. I got about 2,500 hours in that jet, and I deployed 3 times to the Middle East. So definitely an interesting previous career, but now I am focused on real estate full time. So also got my first investment property while I was in the Air Force. So that's kind of what kicked off my journey, if you will. My first purchase of real estate was a duplex. So I bought that. I did the house hacking thing, if you're familiar with that, and it really worked out well. And then I bought another duplex and another, and just have been trying to scale up ever since. I also am a crypto investor. So fun fact about me, I got into Bitcoin in 2013, and I've been hodling strong since then. It's looking pretty good. We're gonna discuss that very briefly in an upcoming slide, but I'm pretty bullish on that. And then Mach 1 Equity I've been going with for about a year. This is my current project. This is in Loveland, Colorado, great little town north of Denver. Me and my partner out there are developing a medical office condo, and that should break ground next month, and I'm pretty excited about that. I just got some updated local market data this week. There was a nice comp that went right across the street, actually, for about $100 more a square foot than we're projecting. Granted, ours is core and shell, so that difference is going to be for tenant improvements or finishes, which I think puts us in a really, really strong spot. So that's what you like to see, right? It doesn't get better than that, than a comp across the street. So, okay, let's dive in. Jobs report. So this past month, we added 1.8 million jobs. So we beat the expectation by about 300,000 jobs. So that's good. But we don't want to get too excited because we're still down 13 million jobs from where we were pre-COVID, right? So we still have a lot of work to do. As far as sectors, the largest gain was in leisure and hospitality, so hotels and that sort of thing. So they accounted for about a third of those gains at 600,000. But that's about a quarter of what they added last month. So we're definitely seeing those gains start to slow down significantly within certain sectors. And that sector alone is down 2.5 million jobs. So that's significant. I mean, 2.5 million jobs is often what we as a country have been adding per year for the last several years, So just for that one sector alone, to lose 2.5 million jobs, still to this point, is bad. Looking ahead, that's going to be a struggling industry, which could be opportunity. We can talk about that. Retail was another big gainer, so they accounted for 15% of the gains at 260,000. But again, they're down 1 million still from where they were. So retail still has a lot to make up for. They saw a big rebound when the economy opened back up, and we'll talk about that as well. But again, looking forward, it's a challenging landscape. So overall, it brought the unemployment rate down to 10.2%, which is pretty much where we were at the height of the 2008 recession. So it's a little better than the 10.5 expected, but it's not a good unemployment rate, right? That's still really bad. The problem is the way it's reported is a little funky, and so they say maybe the true unemployment rate's like 16.5. So they have like 4 or 5 different unemployment rates that they report, and the typical one, that is the 10.2%, does not include people that are not searching for a job. It doesn't include people that are underemployed. So if you go from flying an airliner to bagging groceries, yeah, technically you have a job, but it doesn't really jive with we shouldn't be saying, oh, everything's peachy because all these people have jobs, right? It's not a strong jobs market at that point, which was often a critique. Even when we were at 3.5% employment, a lot of people were critiquing, saying, yeah, we have a lot of people employed, but they're shitty jobs, right? So that's just something to keep in mind, especially going forward as well. On this as well, so piggybacking, the IRS put out a report last week, and they're expecting 37 million fewer W-2 filings this year than last year. So that was just a really interesting report I wanted to share a little color on. And they're expecting a lot of that pain to last for the next 7 to 10 years. So they're saying by 2027, there's still going to be 10 million fewer W-2 filings than there were last year. Now, some of that might get made up because not everyone is a W-2 employee, so we expect the number of like kind of 1099 or gig workers to rise. So that could make up for some of that. But just to put it into perspective, the average job gains per month throughout the recession or the post-recession period, call it about 180, 185. So in order to make up that 27 million over the next 7 years, we need to add 320,000 jobs a month. To do it over 10, it's 225,000. To make up the entire 37 million shortage that they're projecting, over 7 years, it's 440,000 a month, and over 10, it's 310,000 a month. So even their prediction is pretty bullish from a historical standpoint of what we were seeing in the last 10 years in terms of job growth on a monthly basis. So I thought that was pretty interesting. One more thing. So on that chart to the right, so this is continuing claims for unemployment insurance. So this is something that is definitely being talked about a lot. So we're still seeing almost 15 million people as of the 8th. And you can see it's had a fairly steady decline. A few weeks ago, it was very concerning. We saw an uptick. But now what we're seeing is just the rate of decline is pretty meager. It's pretty slow. So that's the big concern there, is that people are staying on unemployment for extended amounts of time, right? So we still have, call it 30 million unemployed, and those continuing claims I spoke about were only down just over 600,000 week over week. Now, when you look at initial claims, so these are new claims, first to the system, those are still over 1 million. So the record prior to COVID was 600,000 claims in a week, and that was like in the early 80s during the financial crisis then. And what's really concerning is, as of the week ending the 15th, there was an uptick from the week prior. So you can see that chart. There was a slight uptick at the end of July, and then it decreased going into August, and then we saw an uptick again. So going forward, if we start to see that tick up, that's going to be concerning, and that's a result of these permanent job losses rising, because there was a lot of people that maybe just saw their hours cut or were employed due to PPP and were able to stay on the payroll. But now that that program is dwindled, those job losses are going to come back in waves. So we could see this really rise over the coming weeks, and this could be a big concern. So, and a lot of this is stemming from Congress just being impotent. And it's funny, I had that same bullet in the last month, and I just left it because they haven't done anything. They went on vacation, I don't know, second week of August. They went into recess until after Labor Day, and they ended up coming back in order to give the post office some emergency funds since that was in trouble. But the fact that they would take a 3-4 week break in the middle of the greatest economic crisis potentially ever is pretty concerning, right? I mean, that just the politics that's going on is pretty crazy, but they're a big part of the story, especially as it relates to this. So consumer spending. So consumer spending has rebounded pretty significantly. It bounced 5.6% in June, and that was on the heels of, so they had record drops of 6.5% in March, 12.5% in April, and then May was up, I think, I want to say 8% or so, 8.5%. So we have seen some gains there, but a lot of that is driven by the CARES Act. So we got $1,200 distributed to most people, plus the $600 a month benefit, and that really propped it up. And if you look at that chart to the right, it shows that not only did the CARES Act replace employee wages, but it actually increased them. So we actually had an increase in disposable income in May and June, because of that $600 a week was actually paying people more than they were making in their jobs. So that is what drove this rebound in spending the last couple months. So retail sales, that's a good indication. That's up 5% month over month, and it's up year over year. So coinciding with that rise in disposable income, retail sales actually eclipsed previous year. But a lot of that is also because there's pent up demand, because those stores were closed for, a month, a few weeks, whatever it was. So, some things are just a need. Sometimes you need a pair of shoes or whatever it is, right? So that's really interesting, but now that's going away. So that creates this concerning dynamic. And looking ahead, sentiment is starting to shift on the consumer side. So you see to the right there, that red line is an indication of consumer sentiment, and it actually dipped in July. So people are looking forward, and they're looking at their prospects, looking out, through the fall and winter, and they don't like what they see. Job prospects are meager. Their financial situation is starting to tighten up, and they're looking at some pain. So that sentiment is dropping, and when consumer sentiment drops, consumer spending tends to drop with it, right? Because people hoard what cash they have, or in this case, I think a lot of people just won't have cash. So now that stimulus is gone, Trump did sign an executive order a few weeks ago, you might have heard about, for replacing that with $300 a week. And then he wanted the states to augment with $100 a week. But most of the states were like, yeah, we don't have any money, we can't do that. And even so, he's using FEMA funds for that. So I know there were some big hurricanes hitting. I think it's Laura. That may take up some of those FEMA funds and reduce the funding available. There was even with, I think it was $44 billion that was in that fund or whatever that he took, and that was only going to last like a month. So he was just trying to buy time, because Congress, they just were on vacation and weren't doing anything. So at least he did something. I guess you got to give him some credit for that. But what's concerning, and this really drives it home, so the Bureau of Economic Research, they did a report a week or two ago to look at the effect of getting rid of that $600 a week boost and what the effect would be on consumer spending. So what they found was, if you reduce it from $600 a week to $400 a week, so you reduce it by $200, you'd see a 12% drop in spending. If you reduce it by $400, you see a 28% drop and if you reduce it by the full amount, 600, it could drop by as much as 44%. So these are the top line numbers, but that's pretty concerning because I think the height of this crisis, spending dips. I think it peaked at about negative 25%, somewhere around there, and that resulted in a 30% decline in annualized GDP. So this is why it's really important. I mean, call it what you will if you're not a fan of welfare or whatever, but this is what's kind of keeping the economy as a whole alive. And if you take that away, it could really snowball and speed up those job losses. So that's the big threat to our economy looking forward, is that dip in consumer spending. So the Q2 GDP was released, and that was estimated about a drop of 33% annualized. So that was a huge, lowest since 1946. It wiped out 5 years of growth. So if you look back at the GDP numbers going back to 2015, we're actually just slightly below the 2015 numbers, I think by like 100 billion or something. So we're going to see a big rebound in Q3, and then the forecast is to end the year probably around like -6 to -8% GDP. So that's a huge drop, right? Q4, this is where the uncertainty really comes in. Like we're saying, is Congress going to pass something? If they pass something, that is the game changer. If they don't pass anything, then we could have a lot of issues. And then, of course, coronavirus case management as well. If we see like this ginormous spike in the fall and winter months, then that could really hold us back as well from making any sort of gains and recovery. So Q4 is kind of a bit of a question mark right now. We'll see how. I think the next month is going to be almost make it or break it when Congress really comes back. If they are able to pass something, then we'll see. My prediction is I think they're going to have something through November because Trump wants to get reelected. So I don't think he's going to let it go away. The $300 a week was kind of his Hail Mary, but I think that card is played, right? So now he's going to probably lean on the Republicans in the Senate to pass something, because otherwise his election chances are pretty nil, right? He's got to navigate this. That's the important thing. All right. One positive thing we're seeing is manufacturing has been expanding. So for the last 3 months, it's been expanding. So below that chart is the Institute of Supply Management Index, and anything over 50 is the industry is expanding. So you want to see it above 50. That's a positive sign. That's growth. So this is the highest level it's been in 15 months. We're kind of entering a manufacturing recession in the fall. So it's good to see some gains. However, we don't want to get too excited about that because a lot of that is attributed to really just replacing the low inventory from when they're shut down for a couple months. So the inventory on hand depleted, so now they're kind of having to make up for that. So, we'll see how that plays out going forward. Some other points just to point out. So inflation is up almost half a point to about 1%. So it's still really low at 1%. But in May, it was basically flat, which was, interesting. And then, what's driving that? Energy's down like 11%. But on the other hand, food is up like 4%. So depending on where people spend their money, some things are actually certainly more expensive, especially in the grocery store. So for average Americans struggling right now, they're seeing some price increases on Main Street. So interest rates are going to remain steady at basically 0 to 0.25%. The dollar has been very weak, so that was down 4% in July alone. And the prospects going forward don't look good. We're printing all this money. We're kind of devaluing our dollar. The S&P is at all-time highs, so the stock market's just out of control. You guys are probably aware of that. Personally, I think it's an irrational exuberance. It makes no sense for all these stocks to be hitting all-time highs and just crushing it when our economy is in the shitter. How do you justify that? Oh, well, it's not based on where we are now. It's based on where they're going to be in the future. Okay, well, the future for the next year or two doesn't look so hot. So it makes no sense for them unless they're just – you can't just price out a stock for 10 years. It makes no sense. But, you know, the fundamentals of the stock market have kind of been going by the wayside for a long time. And it's a lot of just, you know, what is the narrative around a stock? Just look at Tesla. Tesla is more valuable than I think the top 3 automakers combined, and they produce, you know, more cars in a month individually than Tesla does all year, or probably for the next, you know, 5 years. So it's just irrational. Gold is another one that you hear a lot in the news. So that broke $2,000, which was a big psychological point. So gold is becoming very popular. It's anti-inflationary. So a lot of people are looking down the line and they're seeing inflation could be rising in the next few years. So gold is an area that a lot of people like. It's a real asset, anti-inflationary, and it's performed well. I mean, I think it was like 10, 12 years ago, like $900. Now it's at 2,000. So very strong. Bitcoin, another one, circling back to that, hit 12,000. So that was another kind of psychological break, was passing 10. It got to 12. Now I think it sits at about 11.5, but it seems pretty stable. Seems like it's growing some support above 10,000. And this is the second longest streak above 10,000. So I think if it stays where it's at for another, I don't know, it's like another 3 weeks or so, it'll be the longest streak above 10,000. So Bitcoin definitely seems poised to potentially break out and, you know, start working its way towards those all-time highs. I read an interesting article yesterday by the Winklevoss twins. If you've ever seen the Facebook movie, you know, about the Winklevoss twins, they put up like all that money from their lawsuit against Facebook into Bitcoin. And I think they were the first Bitcoin billionaires. So that's their claim to fame. And they're claiming Bitcoin could hit 500,000 as a result of this inflationary period we're going to go into. So, you know, maybe throw 1% of your portfolio on that. Could work out. The Fed was in the news this week. So Jerome Powell, Jay Powell, the chair of the Fed. I like this guy. He seems pretty solid, and he's got a accommodative mindset and policy. So his kind of outlook, he's basically saying, hey, we're not going to touch rates. Even when unemployment starts to tick down, typically a response to decreasing unemployment is to raise rates a bit. But he's saying for the foreseeable future, we're not going to touch rates. So I don't think there was a specific timeline, a year, 2, 3 years, but he's basically saying we're comfortable with just leaving it at zero for quite a while. And he also said we're going to tolerate higher inflation. So normally they're targeting 2%, but he didn't narrow himself down to a band of say 3, 4, whatever. But I've seen projections of, hey, we could see 4 or 5% inflation in, 3, 4, 5 years from now. So that's why gold is up. Real estate is a really good place to be. Bitcoin, all these things are, potentially anti-inflationary assets. And another reason that the government is doing that, which is kind of interesting, is if you think about the amount of debt we hold right now. So there's one of the tactics that they'll use when facing such large debt burdens is to devalue their own currency. So now they're paying off that debt with devalued dollars. So instead of doing a hard default where you just don't pay or you pay less, you can do it. This is considered a soft default. So now they're printing all this money and they're okay with it because we owe so much money that, hey, we can just deflate our currency and now it's the same dollar payment, if you will, but it's valued at less. So it's a way to kind of pay less without paying less, if you think of it that way. So just an interesting look into some of the motivation behind this. And then, so overall, Jay Powell is focused on the working class. He talks a lot about the wealth disparity in the country and what he can do to address that. So by basically leaving rates the way they are, letting inflation go, he's saying, hey, we'll let the employment sector just run with strong, steady gains is the goal. So, all right. So that's kind of the economic update. Let's get into some housing. So housing is shooting for the moon is basically what it comes down to. Housing is hot, hot, hot. It's not slowing down. It's heating up. Home sales are up 14% month over month. So that's a seasonal rate of 900,000 units. This is the highest level since 2006. So, the kind of height of the real estate boom in the early 2000s. The average price is up almost 20,000 year over year, but new listings are down year over year. So, we see this tightening of supply, even though demand is super strong and steady. Existing home sales up 25% month over month, 9% year over year. So this is for the second month in a row, it's had the largest month over month uptick. And then we saw 1.5 million existing homes for sale in June, which is down 21% from a year ago. So new listings are down 1.5%, but existing homes are down 20%. So this is where you see that supply demand imbalance really is clear. And that's pushing home values up. So I think month over month, home values are up like 3%. So last month they were like 294, 295. Now it's 304. So home prices continue to climb during this whole thing, and there's no end in sight. People don't seem to be deterred due to the economic situation. There's just a strong need for housing, and then that's improving builder sentiment. So if you look at housing starts and building permits, housing starts up 22%. That's the biggest gain in 5 years. The annualized rate beat the forecast by about 250K. And you can see multifamily starts surged 56%. So multifamily does tend to be much more volatile than the single family starts portion of it, but that's a serious uptick, right? And then building permits likewise is also beat their forecast by almost 200,000, and you can see single family and multifamily permits up in the double digits. So, and a lot of what's driving the home buyer demand, of course, is cheap debt. So mortgage rates are still hanging out close to 3%, 3.13 for the week ending August 14th, and that's driving a lot of demand from buyers. So that's keeping the housing market steady. So where that goes in the next 6 months is anyone's guess, but right now it's very strong. All right, switching into kind of multifamily. So we have August collections through the 20th, we're at 90% compared to the year prior at 92.1%. So we saw a 2.1 year over year decline, which is pretty much what we saw in July as well. So they're still steady as she goes so far. But remember, we had that $600 a month payment up through the end of July. So all through July, people were getting paid, which allows them to make their August rent payment. So I think September is really the big question, right? So, 1 month after those benefits run dry, where are we going to be? And of course, you got to account for Trump's $300 a week. So that may buy us a month. As far as my understanding is, people didn't even start getting that money until like maybe like this upcoming week. I think only 25 states had applied or been approved for it. A lot of states, I know South Dakota just outright said, we want nothing to do with that. But South Dakota is pretty secluded from the downturn because their coronavirus situation wasn't very serious. But this is really, again, at the crux of everything is that CARES Act. Those extra federal dollars are propping up collections throughout the industry. Overall, July actually saw rents tick up a little bit, so that ended a 4-month decline. We're still down a little bit year over year, but again, it's pretty negligible. Vacancy did tick up a little bit, so you can see there the Q2 ticked up a little bit. Class A is up a lot more. They're seeing a 1% vacancy increase, but overall 25 of the top 30 markets improved month over month. But again, that's a pretty volatile situation, so that could certainly reverse, no problem. On a macro level, the gateway, the kind of coastal markets are struggling the most. San Francisco's down 4.1%. I think San Jose's down like 5%. So a lot of these top markets, Boston, New York, they're going to be the ones struggling the most. The Midwest markets are going to be a lot more stable. There was some surprises. Las Vegas, interestingly enough, was up 1.2%. So the theory is that that's kind of being propped up because it's a cheaper alternative to nearby LA and the coastal markets there. So maybe that they're getting some movement there, which is interesting. On the sales side, prices and cap rates are holding pretty steady. So I think there's been a drop in sales volume, but cap rates are holding steady, and then prices are kind of holding steady. I'm hearing on different podcasts and articles maybe a 3 to 5% price decline. If you hear about these 10, 20% price declines, that's probably just kind of an anecdotal one-off. But overall, there hasn't been much price movement because they're still performing. So how do you price for the next 6 months where you say, yeah, it's looking like there's a good chance that these rent collections could really drop? So that right now is the biggest threat to multifamily. In my opinion, it's the biggest threat the industry has ever faced, because unlike a typical recession, you think about 2008, we were losing 250 to 400,000 jobs. I think at the peak, we're losing 400,000 jobs a month. So it was like a rising tide of unemployment and delinquencies. So you're dealing with a lot of delinquencies over the year, but they're kind of spread out and you can maybe manage it a little bit better. But right now, if we don't get some sort of CARES Act follow-up, a sequel, then it's going to be like the tsunami of delinquencies that hit the industry. And that could really just decimate it. So a lot of people, that's the big concern. But how do you price that in? Because you don't know. Is it going to be 15%, 20, 30, 50%? We don't know. So price discovery, it makes it really challenging, right? And then there's also lenders that are changing their reserve requirements. Some are requiring 8 months of reserves, others 18 months of reserves. So if you got to keep that much cash on hand, that adjusts what you can pay for a property. But, that price discovery is just struggling right now. So, yeah. And then, didn't even touch on the impact of a new wave of coronavirus. But again, could be another wrench in things that really causes some issues going forward. So overall, I think the big takeaway is just the next few months are kind of make it or break it for the economy, and then by extension, the rental markets. Because if these people lose that income and we see this wave of joblessness, well, of course, delinquencies are going to rise, and that's going to hurt multifamily owners. So how long that lasts is then the next question. But right now, I think the smart owners are ceasing their distributions. They're building up a war chest so that they can weather the storm. As long as you can get through it, your money. Time heals all wounds in real estate. So even when it comes to buying property, is now the right time to buy? There's an argument to be made to kind of wait and see for a few more months. But at the same time, if you get a okay deal and you can do some conservative underwriting, yeah, maybe you just expect that the next year is going to be a little bit painful, and you're probably not making cash flow for the next year. Maybe you're at least withholding what you do make. But time heals all wounds. Eventually, we'll get out of this, and prices will appreciate, rent will grow. The question is just how long does it take to get there? So a lot of people are expecting rent growth to be flat or even slightly negative for the next year. So when it comes to underwriting, basically they're just assuming there's not going to be any growth for the next year or so, right? I'm also hearing if you're planning a value add, maybe don't plan on renovating any units for 6 months to even a year in their underwriting. So there's ways to be conservative. You can increase your vacancy. You want to have a fairly comfortable break-even point and a low loan to value on the purchase side. But at the same time, you can still buy in this environment. You just got to make sure you're making those adjustments. So I think that's the bottom line. Chris asked, what is my thought on mobile home parks? They're typically lower rents and lower income. You're absolutely right. So the demand is there. What's the challenge with those is of all the asset classes. So Class A is going to take a dip because people are going to be moving from A to B, and then Class A is going to be increasing their concessions, especially because you're competing with new properties that are coming on the market. They're empty. They want to get them filled, so they're offering larger concessions. So that drags Class A down. Class B is probably, in my opinion, the best place to be because that renter class is the least affected by the pandemic, and it's kind of that sweet spot where Class A will move into Class B. People in Class B want to hold on to it. Class C is going to be challenging. They're already facing challenges with collections. And then if you think about mobile home parks, maybe as a step below that, the demand is there, but the challenges that they'll face in the short term are probably even higher than Class C. So I know I have a couple friends with mobile home parks, and they were already seeing challenges collecting in, March, April, May. So that's a challenge. And then there's political risk. So if there's some sort of eviction moratorium and you're stuck with people in your units for a while and you can't evict, that's a challenge as well. So I think when it comes to C and Class C and mobile home parks, because that demand is there, once you're able to evict people, there's people to take their place. So you'll get them filled quickly, but that it's just that short-term challenge. So that's why having that war chest, I think, is really important. Any other questions? Cash flow risk. Yeah, exactly. So in the short term, reduce cash flow, and that's why you really want to make sure you've got that war chest. I think other assets like hotels, obviously that industry is really challenging. I think it was Victor Menashe's podcast earlier this week was talking about there's something like 30% of the mortgages backing hotels are, delinquent or in forbearance or some other struggling. So that whole industry, there could be a lot of opportunity in that industry to buy an asset at an for pennies on the dollar, 50, 75 cents on the dollar, what you would pay, wait it out. Now that you're entering, you can, you just make sure you raise sufficient capital to weather that next year. And then when the demand eventually comes back, you could be in a good place. The risk there is how do you forecast what the demand is going to be going forward? I mean, we've got all these airlines reducing pilots and their flights. So that's going to reduce demand. Areas like Phoenix seem to be pretty stable. What does the apartment look like there? Phoenix was another one that saw some growth in, much like Vegas. So it depends on the market. So you can look at, I think Marcus and Millichap put out a report last month. I recommend checking that out. I believe it had a chart of maybe the top 30 markets or whatever it was. And it had the unemployment rate. So you can look at different cities, and some are in the single digits still for unemployment. Others, like Las Vegas, might be at 20% or some of these other markets. So there's definitely a lot of disparity between markets in terms of performance. So that's definitely something to look at. Those better performing markets are going to do better during the recovery because they've already got a leg up. Do I recommend waiting to invest? Do I think prices will go down? I do think we'll see some price adjustments, mainly because when you've got an increase in reserve requirements by banks, that requires additional capital on hand. So that changes your returns, which means you're willing to pay less for the same property. And then, like I said, a lot of that hinges on if Congress passes a CARES Act 2 in September, well, that buys us however long. Maybe it's 3 months, maybe it's 6 months. The question is, at that point, are we just kicking the can down the road, or is it going to get us to a point where true unemployment can dip below 10%, really start making kind of organic gains, I guess, in employment and spending? So, like I said, if you find a good deal and you can underwrite it conservatively, I don't think there's anything wrong with buying property right now. I'm looking at a project right now in Houston that's a Class B, B plus multifamily. And, you know, as long as the underwriting is conservative and you're able to mitigate out the risks of the next year, I think you can still do really well. The risk of waiting forever is like maybe that never maybe there is never a 10% dip in prices. Maybe the most you see is 5%. So you just waited while the train went by and you missed it. So, you know, what was the right time to buy in, you know, the last recession? It was actually really through, like, call it 2011. So there was a lot of time there. So we could have a lot of time, or maybe it's only, you know, a year or two of struggle, I guess. It's really just hard to say. It's kind of a personal opinion on whether or not you want to invest. But like I said, I would just plan on the possibility of that wave of delinquencies coming. All right. What other questions do you guys have? There's all my info there. If you're interested in talking about real estate, or if you have additional questions, there's my Calendly link at the bottom. You can set up a 15, 30-minute call, whatever you like, and we can just chat, get to know each other, whatever. Or, you know, if you're interested in future investment opportunities, like I said, I might have some opportunities on the horizon. So, you know, it's never too soon to hop on a call with someone and talk about your investment prospects going forward, your plan, your goals. I love talking to people about that stuff and helping people come up with a plan. So definitely reach out. All right. Any other questions, guys? I don't want to keep you here forever. All right. That looks like pretty much it. Like I said, go ahead, check me out on my website if you're not already signed up. Actually, by attending this, you should be signed up. So you should get the next month's report and the alert about the next month's webinar. Like I said, if you guys have questions or you want me to look into something, like, you know, Chris was asking about mobile home parks. So if you want, I can maybe look into that a little bit more for next month, if that's an area that you're interested in. And if that helps you out, happy to do that. Self-storage is another one. There's a question there about the performance of self-storage over 2008. Was it actually as good as the narrative? Because the narrative and I get why you asked that, mobile home parks, Class C storage, the narrative is that, hey, they do well in a recession because people need a place to live and the demand is there. There is demand. People do need a place to live. But the question is, how do they actually perform? Because if they're not actually paying and you're dealing with constant delinquencies, then maybe they're not as attractive as you thought, you know. And the other theory is, in 2008, what was different is all these people lost their homes. We're not seeing potentially as much foreclosures on the home market side because a lot of people have much stronger equity and loans were underwritten much more conservatively. So those people aren't going to suddenly become renters. So the rental market might not see this influx of people like it did in years past. So that's why there's a strong argument that Class B is the way to be right now. All right. Well, thank you guys for attending. I'm going to call it there and look forward to seeing you guys in the future. Take care. Cheers. Bye.